Okay, good morning, everybody. Thank you so much for coming for this event today. I know it's not easy to get up early in the morning and come up to the CBD area. So I'm sure that everybody here is sincerely keen to learn more about the market trends and how to make profit from this bull market this year. So I know that a lot of you are local shares investors, right? We love to hear about penny stocks and maybe some blue chips of Singapore. But actually, over the last 6 years of my trading experience within the retail space as well as the institutional, the fund management space, I realized that there are plenty of more opportunities outside of Singapore. Just give you one figure. You know, the entire market cap of SGX, right, what's the percentage of SGX market cap as a percentage of global market cap? Make a guess. I'll give you one figure. For US, okay, the 3 stock exchanges of US, they account for more than 40% of global market cap. For Hang Seng, this number is about 12 to 14%, okay? Then make a guess for Singapore. How big is it? Huh? Make a guess. 1, 10? Half. Half a percent. Wow, you are very pessimistic. Actually, the number, according to the end of last year, I made a calculation myself. It's about 0.9%. Okay? So whatever you're trading is within this 0.9% of global market share. And imagine that there are another 99.1% opportunities, more volatile, more growth stocks, more value stocks outside of Singapore. And this is what we are going to explore today. Now I want you to forget what you heard just now. Okay, just forget everything and clean up your mind. And we are going to take a look at the rest 99%. Okay, and there are many, many opportunities. And if you can be successful in trading Singapore stocks, I'm very sure that you can be more successful in trading shares outside of Singapore. Because the local market actually underperforms. Do you realize that? Local stock market actually underperforms the regional peers. We don't even compare with US or NASDAQ. Underperforms Hang Seng, right? A lot of people nowadays are moving to Hong Kong shares. Okay, so before we start, I want to share with you that my name is Margaret Yang. I'm representing CMC Markets Singapore. We are a leading CFD and FX broker globally, and CMC Markets is listed in London Stock Exchange. We are a listed company, and we are the top 5 in the world in the CFD and FX trading space. Okay, this is the disclaimer. Whatever I used, the examples or charts, okay, in today's presentation is solely for information and education purpose only. All right, and they are not constitute of any financial advisory or trade advisories. And because usually my technical analysis workshop is about 2.5 and 3 hours, and it's impossible for me to cover every details in today's presentation. So we have arranged a few upcoming seminars next Tuesday and the following, and the 9th of September, all those free education seminars that you can register today with our salespeople outside and attend my full session of TA workshop later on. And because today I have only 30 minutes and I have already wasted 5 minutes. Okay, these 30 minutes I'm going to break down into 2 parts. The first is market outlook for the second half of 1/7. Another half is what is Fibonacci ratios, what is golden ratio, and how we can use Fibonacci extension and retracement in trading and finding the support and resistance levels. This strategy works very well in the last 6 months because market is one way, not Singapore, the other markets are. One way is super bullish, okay, always go up. So in a trending market, Fibonacci extension can help you to find the major resistance level that you can take profit and wait for retracement before you enter in again. And you will see a lot of examples in my presentation later on. So we start with, global outlook. Okay, look at 40% of global markets, US market. Here I show you this S&P 500 index. Monthly chart over the last 30 years. So it's very clear that where are we now? We are right here at the right-hand corner. Right now, S&P is at historical high, all-time high. Dow Jones, NASDAQ, same. And look at these 30 years. If you take a very broad horizon, you will see that the market trend is super clear. Regardless of the daily movements, up or down, this is a bull market. First bull and the first bear. Okay, this is a 1999 dot-com bubble burst, right? Then entered into a bear market. And the second bull until 2007, the global financial crisis, then entered into a bear market. And now we are at the mid or the end of the third bull market. And this is the longest bull market we have ever seen in the 3 decades. How long is it now? From 2008 till now? It's 8 years and 5 months already and still going up. And the reason behind this bull market, I would like to summarize into 4 points. The first 3 points are the 3 rounds of quantitative easing. As many of you may know that quantitative easing means printing money, right? Central bank printing money. A lot of liquidity goes to the real market, to the economy as well as the market. The hot money go to stock market keep going up. And then after end of 2016, things changed a little bit because Federal Reserve has already stopped asset purchasing program. Then why is the market still going up? A lot of people say that is because of Donald Trump. In fact, the Dow Jones index has rallied more than 20% since November 8, since the day that Donald Trump became the president. Another 20%. Because this guy, he made a lot of promises. He says that he's going to cut tax, fiscal stimulus, and deregulation. A lot of things that he mentioned, and Wall Street chose to believe in him first. And later on, we are going to discuss this in much more details. And on this chart, I have drawn this linear regression. This is one of the functions in CMC markets. I know that linear regression is quite powerful. Okay, the middle line here is the mean reverting line. It's the historical mean that the market is trending within. Okay, and the area above this mean reverting line is the overbought zone. Below this line is the oversold zone. Okay, and right now we are in the super overbought zone. Okay. Looks very dangerous, huh? Actually, it looks very dangerous. But the market is still going up. Anybody knows the reason why? To know this, we have to study a little bit about fundamental. Okay, so here is a little bit tricky. Look at white line here. It is the S&P 500 index over the last 5 years. The green line is the PE ratio. PE ratio measures how expensive the market is. And look at the PE ratio. It's right now for S&P is above 20 times price to earning. And this is the highest level since the global financial crisis. So a lot of people are worried that, wow, the market is so expensive now. So it's very fragile. Any bad thing happen now, the market can enter into a deep correction, right? So people will have this concern. And Wall Street also agreed that the S&P 500 US stocks are getting more and more expensive now. But a lot of people forget about one thing, which is shown here in the purple color. EPS stands for earning per share. So here I have pulled out this data. The earnings per share measures how much money the companies are making on a per share basis. And this is the average earnings per share of the S&P 500 companies. And look at this. You know, quarterly earnings, right? Every time the quarterly earnings come out, we know that how much money the company made over the last quarter, right? And every time after quarter earnings, there will be a jump of the EPS. A jump means that over the last quarter, the companies on average are making more and more money. Okay, and we have seen 3 consecutive quarters of jump in EPS. And right now, it has hit a historical high. What does it mean? The US companies, the largest 500 companies listed in the US are making more and more money. And this is something that nobody can cheat, okay? The companies are making more money, so they have more cash in hand, so they can invest more into their R&D, they can spend more money to do share buyback, they can even give more dividend to the shareholders, okay? And that's why the market is very bull, because the economy actually has recovered for 3 quarters already from the US, and that momentum has spread out to European and China and even Singapore. We have seen Singapore economy, the GDP, and export being recovering since early of this year, right? So this is a very good measure of that. If we take an even longer horizon, over the last 3 decades, we have seen a very positive correlation between the index and the EPS. Look at in this chart, okay? So the white line is the index, S&P, and the purple line here is how much money the S&P 500 companies are making. Look, their earnings has reached a record new high. So as long as the companies are making money, the market will remain bullish. Okay, regardless who is the president of United States, regardless whether or not the North Korea tensions are escalating, or regardless of all these geopolitical tensions, those are minor factors will create some volatility. But in the end, we have to agree that the fundamental is improving globally. Okay. But the question in many people's mind is, how long will this bull market last? That's a very big question. A lot of people has been calling for a crisis, a crash, since I joined the industry. Many years ago, a lot of people say, oh, it's going to crash, our market is going to enter into a correction, and this kind of valuation just cannot sustain for a long time, but it just continues to go up. So in the second half of 2017, actually there are 3 factors that investors should monitor, which will affect actually the fundamental of the markets. The first is Trumponomics, because the 20% rally in the Dow Jones is partially contributed by Donald Trump. Okay, he made a lot of promises. But after 8 months from his inauguration, have you realized that he kept talking and twittering, but nothing get done yet? Nothing, seriously. I show you a chart later. So his promises become more and more like empty promises. If one day, everybody, including those in the Wall Street, realize that this Donald Trump is a bluffer, and he couldn't implement any of those tax reforms or fiscal stimulus or everything, this bubble will get burst first, okay, Trumponomics bubble. And that's something we should monitor carefully. The second and third point is even more important. Federal Reserve and ECB, European Central Bank, are planning to shrink their balance sheet and start a tapering as soon as end of this year. And this will affect our market because liquidity will be pulled out. What is liquidity? Basically, it means money. Since 2008, they have been injecting money into the market and market go up, right? And now they're going to collecting those money back. What will happen? What will happen? The reverse could happen, right? And that could potentially result in a liquidity crisis if they do this too fast and market is unprepared for it. So this is the liquidity part. And regional issues will create some temporary volatility, but that's not a big issue. For example, Brexit talks, it is something within the European Union, and in particularly UK. So whatever happened in the UK, right, you see Singapore shares selling off, don't worry lah. Nothing to do with us. So very soon, after all these things calm down, the market will recover. And that correction is what we call a technical correction. And that is something that you can look to enter into the market because it doesn't really affect the fundamental of US or Singapore. Okay. And North Korea tensions, like what happened a few weeks before, right? You see that volatility spike up and very soon come down. Okay, these are the very minor regional issues. And China credit bubble, and this is a long story, but I don't think this will get burst anytime soon. We have to monitor it. Okay, so Donald Trump's to-do list. Since his election campaign till now, he has made a lot of promises, and I have summarized some key points here: tax reform, trades, infrastructure, and financial energy deregulation. He's going to sue Hillary Clinton, and that has become a joke. And he wants to repeal Obamacare, and nothing get done yet. So market is fairly disappointed, right? If he cannot push through any meaningful reforms, sooner or later, Wall Street will forget about him, right? And we will see some unwinding activities. So this is his Make America Great Again. Then let's talk about a little bit of Federal's balance sheet normalization plan. What is normalization? since 2008, Federal Reserve has injected more than $3 trillion of liquidity into the real economy through the purchase of MBS, mortgage-backed securities, as well as US Treasuries, and a little bit in the foreign reserve. Okay, so money is not created. Money is created in the real economy, in the business operations, right? But here, for the central bank, money is not created. Instead, I would like to use another word, is borrowed from the future. They are the debts, okay? So Federal Reserve printed this money from the future. They borrowed money from future, and this debt is something that they're going to pay back sooner or later, and now is the time, right? So they printed the money, injected it into the economy, and as a return, they get all these T-notes and MBS and gold, etc., back to their balance sheet. So this balance sheet is now 4.5 trillion US dollars, and they are essentially worthless certificates, right? And look, this is something worrisome because historically, look at the Federal Reserve's balance sheet as a percentage of US economy, GDP. It is very stable at about 6% before the financial crisis time. And after the 3 rounds of quantitative easing, because too much money are printed and borrowed from future, now this ratio has increased to 24%, 4 times higher. Okay, and this is Federal Reserve's balance sheet, you'd see, has been going up and up because of the quantitative easing. And sooner or later, they have stopped this from growing further, but now they are talking about claiming the money back. And imagine what could this affect our markets. There could be a reversal, right, if they do it really, really fast. And similar things happen to the ECB as well, because we know that European Central Bank and the Bank of Japan, they are following US to implement this quantitative easing. And since their quantitative easing started at beginning of 2015, and since then you see this ratio, ECB's balance sheet as a percentage of Eurozone GDP has soared from pre-crisis level 13% to 36%. Okay, and now they are talking about what time to start the tapering. Okay, so they're basically following the Federal Reserve. And an immediate result of ECB tapering is that the currency market get impacted first, okay, before the stocks market, okay. And look at this chart is the euro dollar, the euro versus USD, okay. And we have seen that this is a 4 years chart. And look at this huge movement in the currencies market in response to all these central banks' quantitative easing and tapering movements. This is when the Federal Reserve starts tapering, because Federal Reserve stopped printing money, US dollar strengthened. And since then, euro has dropped a lot, more than 20% against US dollar. Okay, US dollar was strengthening. Not only euro, look at Sing dollar. During that time, Sing dollar has weakened a lot against US dollar, right? That's a huge impact. And ECB finally starts quantitative easing since 2015. And because ECB started printing money, look at euro, it was traveling within this very low area in the next 2.5 years. And right now, recently, they are talking about ECB plans for tapering. If ECB stops printing money, the euro will get stronger. And this is why we see that euro has been rallied against US dollar for more than 12% since the beginning of this year. Okay, so euro is increasing. And that is how, basically, a very simple model that how the Federal Reserve and ECB in their movements can affect the currencies market. Okay, and euro strengthen is actually a bad thing for the European stocks. Okay, usually the currency goes stronger, the market will go down a little bit. And we zooming further because this year we have seen that US dollar has been weakening against the euro, and this represents the dollar index, is how strong that US dollar is against other currencies, including euro and Japanese yen and sterling, all those. So we have seen that US dollar has been traveling down. Okay, and last night, because of the Jackson Hole meeting, right, Draghi gave a very optimistic outlook of the Eurozone economy, and euro strengthened further. So dollar index actually came down quite a lot to 92.4 something. So US dollar has been keep dropping. And this is how we can, we have a fundamental background, and the next we are going to crystallize of this fundamental into the tradings. And here is where we start to implement technical analysis tools. In my technical analysis workshop, I have plenty of trading techniques and patterns, Fibonacci is just one of them. So because of the time constraint today, I'm just going to introduce you how to use Fibonacci in finding support and resistance levels, okay, and finding entry and exit points. If you want to join a full session, please register for my upcoming technical analysis workshop. Okay, so here, dollar index. From this chart, we use a Fibonacci Extension tool. It's one of the functions in CMC's platform. To use it is very simple. The key is to identify 3 key points. In a downward projection, you find the first point, which is a significant high. After that, you have a first low. After first low, the market rebounded a little bit, but it's a technical rebound because the third point is a high is lower than the first high. When you find a high, a lower high, what does it mean? The rebound is not strong to reverse the trend, and it's more likely that this trend will continue to go down. So here we do a downward Fibonacci extension projection. Okay, so basically on the chart, you just click 1, 2, 3 points, and the system will help you to plot all these lines, and these are Fibonacci extension lines. And look at what happened. Okay, for Fibonacci extension, we know that we must understand that 61.8% is a key Fibonacci level, followed by 100%. After 100% is 161.8%. After that is 200%. Remember these 4 numbers. They are the key support levels for a downward projection. And the rest of the lines are the minor support levels. And look at this extension, actually, because the momentum was so strong that this extension hit all the way until 161% before it finds a bottom and since rebounded back. And rebounding back, you see, at 100% Fibonacci level, it hits a resistance. And look at how useful these Fibonacci levels are and how accurate they are. I have many other examples, not only in the dollar index, but also in the stocks, indices, even commodities market. I will show you more examples later on. So let's come back to what is Fibonacci. Fibonacci sequences started from 3 numbers, 0, 1, 1. And then you add every 2 numbers, you get the third number. You plus 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8. And these sequences goes on and on until infinity. And what's the beauty of these sequences? Every number divided by the number next to it, you will get a number of 61.8%. Later on, you can do it yourself. You can go back and use a calculator. Every number, 89 divided by 144 is 61.8%. 144 divided by 233 is 61.8%. Okay, and the reverse, if you use 89 divided by 55, it becomes 1.68. 1.68. Okay, and as the numbers goes bigger and bigger, the number gets closer and closer to 61.8.181818 and etc. So scientists and artists did actually derive this golden ratio from Fibonacci sequences, and this golden ratio is 61.8. Okay, it's a rule of nature, and magically traders find Fibonacci sequences are very useful in tradings. Okay, so because they can define a retracement levels and forecast the extension of a correction, okay, or a pullback. So here we have derived all these Fibonacci sequences ratios, and I have categorized them into 2 parts. The first part is retracement. The second part is extensions. Retracement are numbers between 0 and 1. Extensions are numbers larger than 1. Okay, so these ratios are starting from golden ratio, 61.8. Okay, 1 minus 61.8 is 0.382. And a square root of 61.8 is 78.6. Okay, then followed by the round number 1. After that, square root of 1.618 is 1.272. Okay, and 1.618 and 2. Oh, these are the key Fibonacci ratios. Don't worry about these numbers and how to derive them or how to draw them on the chart. No worry, because nowadays the technology is so advanced that our platform, you just need to know 3 points, and they will do this projection for you very nicely on the chart. Okay, that's starting from Fibonacci retracement. Okay, retracement is when the market finishes this rally. Okay, this rally is done and starts to move back. Okay, this is what we call retracement. So retracement is easy. You just pick 2 points, the starting point of the rally, the end point, the peak of the rally. That's it. And it will do this projection for you. And look at all these numbers, 23.6, 38.2, 50, 61.8, and 76.4. All those are the Fibonacci retracement levels. And look at the retracement. Actually, a lot of times we will find a support at around 61.8%, the golden ratio, around here. And look at dollar yen. Actually, it find this bottom around this area and being hovering there for 5 trading days. 5 trading days you may think is not too long, but for Forex traders, usually they in and out within a day. And if you notice that this is a key Fibonacci extension, Fibonacci retracement level, actually you can do a lot of intraday tradings around this area because you know the support level is there. So you can leverage on this. And after that, again, 76.4%, another support level. I have highlighted in the circle here. Also, the dollar has been hovering there for how many days? About 6-7 days before it breaks down further and hit 100% level. 100% level, again, proves to be a strong support level. As the Fibonacci number gets bigger and bigger, the support gets stronger and stronger. Okay, so this is a retracement. Another example, euro dollar, I would like to use the extension. You know that at beginning of this year, because of ECB tapering expectation, the euro dollar was very strong, keep going up. So here we find 3 points, do an upward projection, because fundamental tells us that it's more likely that euro will go stronger, right? And you want to know that where it is going to reach. So you find a low, a high, and a higher low. Basically, if you get low, high, and higher low, it tells you that more likely the market is moving up. And the system will draw this Fibonacci extension for you and look at 100% Fibonacci level. Okay, actually it hit this level before tracing back and go up again, and then hit 123.6% level. And this is an even more powerful extension. It's a GBP CAD. And look at this extension. We have a high, a low, a higher high. And after the higher high is finished, look at these 2 long-range bars. Be careful about long-range bearish bars. When you see this or you see a gap down, it's a very strong signal that the bearish trend is very, very strong. And when you see this long-range bar, it is highly likely that the price will go down further and go beyond 161% Fibo level. And in this case, yes, it actually break down 161 and hit 200% Fibo level. And look at how magic it is. In this extension, right, the price actually hit 200%. Just nice, stop here, and start to rebound back. Okay, so this is a 200% Fibonacci extension level. In my real trading experience, 200% is very, very strong that usually it won't break down. So a rally goes to maximum 200% extension. And here is where it must take a break before it go down further. Another is S&P 500. Okay, we have identified a low, a high, a higher low, and the trend is moving up. And look, here it stopped at 161.8% Fibonacci level. And where is this level? 2483. Go back and check the S&P 500. The highest level that it has been to is exactly this level. It hit this level intraday and come back. entered into a correction. And right now it is around 244 something. It is still around this area. So in the near term, 2483 is a strong resistance level. And it also applies very well in the crude oil. Crude oil here is a 100% extension. Due to the time constraint, I'm not going to stop here for too long. Hang Seng Index as well, and Fibo works very well for Hang Seng. And even silver, gold and silver. Okay, and silver here is a downward projection and hit 100% Fibo level. And Fibonacci extension is just one of the tools that we are using in the intraday trading and in a range trading. Actually, we combine Fibonacci extension with many other tools like super trend, DMI, and some chart drawing, okay, to determine a very precise entry and exit points. Okay, and this is we are going to share with you more in the upcoming seminars. So this is my 3 hours technical analysis workshop and trading strategies. And you will find that Fibonacci extension and retracement is just one bullet point in this workshop. So in order to have a refined trading strategy in global market, you can register for the upcoming seminar on next Tuesday evening at CMC Market Office, 7 to 9 p.m. Okay, and in the seminar, we're going to share about starting from simple moving average and on to super trend. After that, Bollinger Band and Fibonacci extension, momentum indicators, and patterns. Okay, in patterns is very powerful but very difficult to master. And I'm going to share with you what is ABCD pattern, what is butterfly and Gettler, and then we're going to do a screening with cup and handle. All these powerful patterns in trading. Okay, so here are the details of the upcoming seminars. And for a lot of you, you can actually go to our booth downstairs and get a brochure from our sales staff and register for these seminars. One is next Tuesday. Another one is a Mandarin full day event organized by CMC Markets on the 9th of September. All of these events are free. And a Mandarin event on 9th September, we have invited another 3 keynote speakers. They are Da Wang, Dr. T, and another Forex expert from New Zealand to share with us their strategy and market outlook. Okay, now I would like to invite our sales executive, Amy, to share with you our account opening promotions.